it's fine. You can do that.
Good morning, sir. On behalf of the Entrepreneurship Development Cell of St. Xavier's College, Kolkata, it is with great pleasure that I extend a warm welcome to each one of you to the speaker session of Enterprise 2024 and Inter-College Entrepreneurial Stimulation. It is with utmost honor, privilege, and gratitude that I introduce to you a visionary leader, Mr. Siddhartha Sanyal, the Chief Economist and Head of Research at Bandhan Bank, who graces us as the distinguished guest speaker for today's session. Mr. Sanyal brings with him extensive knowledge and experience. His navigation of the corporate landscape has left a lasting mark on every endeavor that he has undertaken. We are beyond delighted to have you join us, sir, and relay your experience, expertise, and journey to curious young minds. We are extremely thankful to you for taking time out of your busy schedule for a session with us. On behalf of everyone at EGC, I extend my best wishes to all participants for an insightful learning experience during this session. I now hand over the virtual podium to you, sir.
Thank you very much, Sanvi, and thank you very much, EDC. Really, really happy to be part of this particular discussion and this particular initiative. Uh, there's nothing to say. There's nothing new about the quality of the programs, etc., from an institution of the stature of St. Xavier's College. Uh, but I think it's great to see that you have a special focus on entrepreneurship development, and in my presentation I'll try to explain why this is so very important today. I'd I intend to have a presentation for about 45 minutes and then would open the floor for another 15 to 20 odd minutes of discussion if there are Q&A. So give me 30 seconds, and I'll just try to come on that particular I'll just try to upload that particular presentation. Give me a few seconds. Give me a few moments. I'll just. Please let me know if you get to see the screen from my side, the first page, if you get to see.
Yes, sir, we can see it.
Okay, that's great. So the topic that we have chosen today is global mega trends and how it can actually impact or likely to impact businesses, economies, and financial markets over the course of the next few years. And we'll possibly start and focus a lot on how exactly things are unfolding at the global scale, because there are some very important changes that are taking place at this moment, and how exactly that has a very significant bearing on everyone under the sun. So the way I see global economy and financial markets today, that as I run you through some of the next slides, you'd get to see that the degree of uncertainty in the global economy has actually increased manifold, possibly over the course of the last a decade or so. But interestingly, if that is a risk or if that is a problem statement, we have a very interesting solution in hand also. very clearly you get a sense that you get strong evidences what can actually suggest that the global economy is possibly learning very fast to cope with a lot of these uncertainties. I hope the slides are changing. You can see my slides, right? Can someone please confirm?
So we can still see the first slide.
Oh, so how exactly?
So can you just move to the slideshow button and then we might be able to see the entire presentation.
Yeah, I am on the slideshow button only.
Right, so we can see your
But
third slide now.
you can see the third slide, but let me just try to see if the slides move. Is it moving now? Or is it sticking to the third slide only?
Yes,
No.
sir. It's visible now. We can see the third slide.
You can still see the third slide. Do you see a paragraph written there, or you can see a chart?
So we see the paragraph.
Then that means for some reason, in case of the slideshow, it's not moving. My apologies. In case of the slideshow, it's not moving. Possibly you can see a chart now.
Right, so we can see it.
Okay, is it okay if I show you on this particular version only?
Right, so it's absolutely fine.
Okay, fine. In that case, we'll not spend more time on that. Uh, so if we talk about global business environment, it feels like it reminds you about the famous novel, A Tale of Two Cities, and the opening paragraph, if you recall, or if the opening line, if you recall, it was the best of times, it was the worst of times. It almost encapsulates, or it almost summarizes the situation that global economy, global businesses are going through today. So there is a high degree of risk, high degree of change. So it depends a lot on which side of the change you place yourself, or you manage to place yourself. If you are on the right side, possibly you benefit disproportionately high. But if you cannot cope up with the changes and the new challenges, it's possibly very difficult today to run businesses. So in a lot of cases, the policy cycle, the technology cycle, all these cycles seem to be has been shrinking a lot, and as a result, a constant change, constant improvement, constantly coping up with newer realities is possibly the need of the hour that we'll possibly explain and discuss in over the course of the next few slides. Why it is so very evident, and how we can see it in case of the global economy and some of the other economies also. Coming to the year that we have just finished, 2023. There was, when the year started, there was a lot of doubt, debate that this is a year in the global economy you might see a recession, or at least in the US economy you might see a recession. That thankfully didn't really take place. So this particular chart, while this just shows the red dots, which is a more recent set of forecasts for the global economy, advanced economies, and developing economies, all actually moved towards the right. So that means 1 year back, whatever had been the forecast for growth, all these numbers eventually improved over the course of the next 1 year. But nevertheless, we still know that we haven't really recovered the entire loss that at the COVID time the global economy has faced. So basically, the yellow line was the projection in 2019, that is the pre-COVID time. What would be the path for the global economy over the course of the next about 10 odd years? When the COVID hit, we moved to the red line, which was a clear loss to the global economy, and this particular gap between the yellow line and the red line actually shows the gap that we are still maintaining. And the blue line is a more recent chart, which actually took a bit of a hitting from around the time of the wars in case of for 2023, and that's why we eventually saw that the estimates for global economic growth in 2023 moved a tad lower compared to what had been the projection in 2022. more than just 1 year and forecast for 1 year, I think this particular chart. Uh, Also, one more question: can you get to see the cursor when I'm moving it? It will be slightly easier for me in that case.
Yes, so we can see it.
Okay, great. So I think this particular chart is very, very important for me. That this is showing that this is a 5 year average for global growth, and this is showing, and I'm sure the same trend will be holding if we can extend this particular chart backward. That there was a time in the 90s or even in the early part of 2000s when global growth on an average was moving higher. Then there was a phase for about 20 years, or at least about 15 years, when it moved broadly sideways. There was one particular period when there was a drop. It was the global financial crisis. If I ignore that particular part, broadly you can see global growth on an average moved broadly sideways. But during the course of the last about 8-10 years, we have seen that particular number has started, or that particular average has started moving a little lower. Not necessarily just because of the widely discussed COVID. Here we get to see that even before that, there was a dip in the overall number. And this particular chart, this is a chart from from one of the publications of the recent publications of the World Bank. I think this particular chart encapsulates it very well. So basically, we get to see a significantly larger number of countries globally are witnessing growth rates which is lower than what they had witnessed in the previous decade. So long story short, that in the some 15-20 years back, there was a strong trend of globalization and strong global growth, like a high tide, which was supporting a lot of countries, including ours, to lift the growth rate higher, lift businesses higher, and providing us a lot of tailwind amidst increasing degree of globalization. Now we can debate about the factors, but what we get to see that there are challenges on the global economic front, and it will be naive to have a very optimistic assumptions straight away about global economy straight away. So basically, you have to find your way as a country, as a business, or as player of a financial market. You have to find your way. It's not that there is high tide and all boats will be lifted higher. It's not the case. It's a long presentation that I'm carrying. I'm not going to show you every bit of it, but some of the charts that if I can just show you, uh, in the global economy, for a very long period of time, we had been discussing about there are certain countries which are enjoying a very positive demography, a few countries which are not really enjoying that positive a demography. Thankfully, we are at this moment at a very privileged state. But as you can see, this particular red line, and AE means advanced economies. You can see that we are now we have entered at a phase that where the working age population as a percentage to total population in a number of advanced economies are on a decline. It has it has implication which can be interpreted in both ways. You can and depends on where exactly you focus, where exactly you operate from. You can actually gain or gain from it, or maybe you might be at a receiving end. So we need to we need to figure out carefully what are the implications of this particular situation. But what is true for everyone, that these two charts are actually areas where it has implications and some bit of headwind for a lot of businesses going ahead. We get to see that improvement in human capital indicators. If you see over the course of the last 2 decades, the the decade before the last was on a much stronger footing compared to that. During the 2010s, we we actually saw a little bit of a loss in momentum so far as human capital indicators are concerned. And at the same time, if I see now, global policy uncertainty on the chart on our right has increased very significantly. And the last but not the least, as we are talking about earlier, This particular chart is also a very simple chart, but a very interesting one. This shows uh, merchandise trade, global merchandise trade as a percentage of global trade, global GDP. And here you can see again some kind of a shift in this particular pattern during throughout the 1990s to for about 15 odd years. You can see this particular line broadly moving higher and higher, but after that it has by and large has moved sideways. That is telling you the tailwind of globalization, which had been a very significant tailwind for both for advanced economies as well as for developing economies. We seem to have seen a of momentum on that particular parameter over the course of the last 15 odd years. So just having a very buoyant assumption or strong assumption or positive assumption may not be very wise. You have to actually have a relatively more cautious assumption. Of late, we have seen a few factors where we have seen that these two charts seemingly look difficult or seemingly look a little complicated, not so complicated in reality. These are showing how over the course of the last 2 years, during 2000, not really last 2 years, 2021 and 22, when we have seen phases of very high inflation during the post-COVID recovery, how inflation forecast moved higher, higher, and higher over the course of 2 full years. And thankfully, it has now started moving lower. We seem to be on a slightly more comfortable zone at this moment. But what it has led to very significant rise in interest rates globally, policy interest rates. And if I capture it here, you get to see that from various central banks, this is something we all follow these days as students of business, commerce, economics, etc. That in case of US, Eurozone, UK, Japan, everywhere, not so much for Japan, but apart from that, maybe for most other developed economies and advanced economies, we have seen a very significant uptick in policy interest rates over the course of the last about a year and a half. Now, I'll come back after a slide or two, or maybe I can just follow that. See this particular chart very carefully. This clearly shows the lines have gone up like mad of late over the course of the. Looks like these are at highest possible levels. So there's a central bank policy rates like our repo rate. They have, in case of US, they have the Fed funds rate, etc. So looks like it has gone at levels which had never which was never seen earlier. See this particular chart carefully, and I just move to a next one. The same chart here, the time horizon is about 10 years, but now in this particular chart, it's almost the same chart. I just changed the time horizon to about 40 years. And if I do that, on the right-hand side, you can see that even though these lines have moved very sharply of late, this is nothing compared to some of the other periods in the past that we have seen. And you can actually go for a longer history, and there also you will be able to make out. So this particular red line, the same sharp spike, but see, compared to the 1980s or 1990s, or even at phases of 2000, we have seen levels higher than this or much higher than this. So while there is very strong expectation of the US and some of the other central banks cutting rates in the next few months, starting next few months, very aggressively, we need to figure out that whether that becomes a short cycle or that becomes a very a sustained trend. It might actually be difficult to imagine a situation that there will be a lot of rate cuts ahead of us, maybe a couple of percentage points at some point of time, but not necessarily that can actually be a determining factor. Even for inflation, we have seen inflation levels, which is in the first chart, but in the past we have actually seen inflation much higher than that. So nothing gives you the certainty that we have necessarily. So if you take the next 1 year, 2 years, you possibly know that it's very unlikely that we'll, unless there is a war-like situation or fresh bottleneck to supply chains, etc. Uh, you will possibly not see an interest rate hike. You will possibly see a easing of interest rates, but it cannot be a sustained trend for a very, very long period of time. On the other hand, if you actually see, even if I take a 40-year kind of a view, this particular chart capture looks very similar, but it captures two different variables. One is fiscal balance or fiscal deficit. And you can see that in case of advanced economies, that is the red line, we are at a level, or we have seen levels which had never seen. So here, in case of a negative number, that means a deficit. So you can see that in case of advanced economies, you have seen fiscal deficit levels which were never seen in the past. Or here you can see on the right side, right chart, that you have seen public debt or countries' indebtedness at levels which are never seen in the past. Interestingly, these are 40 years charts. Interestingly, if I actually extend this particular chart for a fairly long period of time, from about 1900, then also you can actually see the red line, which is the country's government debt level, is at some kind of an all-time high for the advanced economies, or for the global economy, so to say. Also, in case of the fiscal balance part, you are seeing a fiscal balance, or you have recently seen a fiscal balance at the COVID period, which had never been seen. It was never seen in history, not even at the time of First World War, not even at the time of Second World War, that you have seen this kind of fiscal deficit. So basically, all I'm trying to say, that in case of global economy, there are certain levers which can actually push growth higher very quickly, like a stimulus. It can be a monetary stimulus, it can be a fiscal stimulus. But it looks like the global economy and global policymakers have utilized them. I mean, those levers, or have used those levers very extensively, very aggressively of late. And for the global economy as a whole, it's not very easy to continue with pushing with those levers continuously. So that's why your assumption about global growth, momentum of global growth, needs to be relatively cautious. Now, if I sound very sober, very a bit negative at this moment, I think I've come to a level where I'll possibly do a bit of a shift of gear pretty soon. First of all, what we get to see, that even though there had been a lot of volatility, policy uncertainty, interest rate hikes, all these things that we have discussed, very clearly it looks like the global economy is learning better to cope with these uncertainties. This particular chart is a VIX chart, or volatility index chart, which is the volatility index of financial markets across the globe. And that and here, lower the better is the number. So basically, here where we get to see that earlier, in case of the global financial crisis in 2008, the VIX hit a level which was possibly to the north of the level 60. In case of the COVID, which was possibly an even bigger surprise and an even bigger crisis for and across the globe. A global financial crisis was, even though we call it global, it's not possibly equally damaging for every country at the same time. For COVID, it was much more sharp, much more surprising. But then, even then, at that point of time, we got to see that the VIX value was relatively lower, and eventually, even at the levels of various wars and all, we get to see that the VIX levels are relatively better or lower. So basically, we get to see a situation where we see the global economy is learning to cope a little better. But if I really need to see a few positive stories in the overall not so charming global macro backdrop, I think we are at an enviably strong position at this moment, And from this position onwards, after the first 20 odd minutes of my presentation, I think what I'm going to say now might actually sound a lot more positive and hopefully a little more appealing. So if I see, I discussed at length that why global growth, etc., global growth numbers are not looking very bright. We discussed that why the levers available at the disposal of policymakers, they have used that and they have pushed that extensively. It may not be very easy for them. However, we get to see in this kind of a situation also, there are a few countries which are at very clearly at a better situation. This is there are various country groups. So, for example, this is Latin America and Caribbean. This is Middle East and North America. Similarly, this is the last one is Sub-Saharan Africa. But this one is something I'm very interested in, because this is South Asia region, or in other words, where India is possibly a very dominant player. So very clearly you get to see, if I talk about, and this is World Bank's forecast, not anyone less. If you see the forecast from some of the most trusted and credible agencies also, you get to see the growth forecast for India is significantly better. If I see how exactly the growth forecasts, etc., move in case of India over the course of the next few years compared to global growth, we seem to be, the blue line is the India line, seem to be moving at a significantly higher pace, or likely to move in a significantly higher pace going ahead. What would be the share of our economy in the overall global economy? You clearly see this particular number is moving higher over the course of the last several years, and we continue to see that. And again, this is a forecast based on IMF data. Very clearly, we get to see that particular number is moving higher continuously. This is where the country stands at the end of year 25 to up to 2028. This is 2024 onwards. These are forecasts, but previous all years is actually a testament of what we have achieved already. And there also you get to see from about 1.5% of global growth share, you have moved into the vicinity, steadily moved into the vicinity of 4% odd. So the share of the country in the overall GDP is really increasing. Now, a few factors in case of India is actually contributing in a very in a very significant fashion. And if I try to explain that, not necessarily with the help of any chart or numbers, but broadly, a lot of you have studied the basic macroeconomic identities, presumably already. So you get to see that growth in any economy is like C plus I plus G into I mean plus net exports, etc. So what is actually driving India's overall growth? One very important factor for India is that the C, or the consumption part, or the private consumption part, is a very strong contributor for India's overall growth. It's still at a nascent stage. The country's overall per capita GDP is moving from $1,000 to $1,500 to $2,000 and further high up. And when it moves in that particular moves in that particular zone, historically it has been seen across countries that their private consumption level not only gets a lot of momentum, but also you start investing a lot in human capital development for the future generation. So basically, you as a nation, the average Indian perhaps have now been able to meet all his day-to-day demands, basic needs, and then possibly in a much better position to invest better for the future generations, or the next generations needs, like education, health, etc., a lot better. And you get to see that getting translated into some kind of a virtuous cycle in a very clear fashion. I just I've shown you this particular chart, that how India's share in overall global GDP is moving. if I actually show you in the next chart that how India's contribution to global growth is changing, that number is actually even stronger. What is the difference? That, say, in the previous graph or in this particular graph, it's like this, that okay, the global economy is say $100 trillion and I am $4 trillion, then my share is 4. But the next chart or this chart is measuring it slightly differently. Say in this particular year, from 100 trillion I have moved on to $110 trillion, the global economy, and India has moved from 4 to 5. Then the contribution to global growth in case of India in this particular year is actually 10%. That in global economy has expanded by 10 trillion and India has expanded by 1 trillion. That means here we are talking about a 10% contribution to global growth in that particular year. So there you can see in recent years how strong the contribution from India had been. I mean, more often than not, there is obviously a lot of volatility, and COVID made that volatility a lot more pronounced. But generally, this particular number is moving significantly higher, and there's a very strong case to offer a lot of optimism to a lot of us. You get to see that we discussed about the consumption part or the private consumption part. Today, actually, you get to see a lot of focus from both investment and government spending in more productive areas in a lot of places, a lot of cities, even in interior places. You get to see that. I think that particular part is also moving at a pretty rapid direction, rapid pace, and in the right direction more often than not. Not necessarily the central government, also a lot of government at the state level and local level is also they are also joining hands. You can see in this exercises, and very clearly actually laying down a stronger foundation for overall growth momentum that can actually continue for a fairly long period of time. Then you have the net exports part. I'm not too sure how exactly that will shape up, because that depends a lot on what are the commodities you import, and often you are a price taker. You have relatively little influence on global prices, etc. So we need to figure out that. But out of the three or four factors in your overall growth, in the list of your overall growth drivers, two or three seem to be in a pretty positive, pretty decent zone, and that should be enough to give you a decent degree of confidence that this particular growth momentum can actually continue for a fairly long period of time. I don't want to get into a lot of details of these areas, but very clearly we are possibly today enjoying a digital public digital infrastructure, which is I dare to say it's possibly not there in any other country at this moment. I'm not talking about the rate of growth. There, obviously, the rate of growth in our case is significantly higher than anyone else. But even otherwise, even in case of the overall position, what we enjoy today in terms of overall public digital infrastructure is possibly enviable. In the last 10 odd years, as you get to see that this particular chart is showing that your overall smartphone users have increased 5x, your Jan Dhan accounts increased by about 3.5x, and the other connectivity, which actually helps in terms of targeting a lot of government programs, a lot of public initiatives, a lot better, that has increased by about 10x. So a lot better targeting, lot better delivery of the government initiatives that is possible today. Is possibly showing up in terms of boosting the growth, not only growth numbers of today, but even the growth potential that can actually continue for a fairly long period of time. In terms of, I don't intend to go into a lot of details just now, but happy to come back and discuss it if there are specific questions around that. But before I stop, that over the course of the next 5 odd minutes, I would like to touch upon a little bit about what are the big trends that we get to see today in financial markets globally as well as in India. So far, what we had been discussing is what are the broad trends at the economy level or the macro parameter level that we witnessed. But a very important reflection of macro parameters typically I mean, financial market is possibly one particular place where you try to get or tend to get the reflection of macro parameters uh, on very quickly in a lot of financial market parameters also. So what we get to see, we discuss that how a lot of countries, like say for example the US, how quickly they had to I mean, push their interest rates or policy rates higher over the course of the last few years. In case of India, also we have seen that particular rate going higher, but not at that kind of a pace. That means in this particular and interestingly enough, that when we had witnessed the reduction in policy rates, or this particular chart is important in a way. Let me try to explain. Uh, and again, if you can see the cursor that I'm using, that when COVID hit, a country like US, a large country like US was uh, had possibly delivered all the cuts, all the monetary easing from the central bank that was possible in almost no time, coming to something like zero. On the other hand, if we see our policy delivery, that was a lot more nuanced. That means whatever the recovery in the the recovery in the post COVID period you have seen in the Indian economy, that possibly came more in terms of natural recovery in health rather than any quick stimulus, which was possibly the case in case of a lot of other countries. That's why it gives you a little more confidence about the continuation and less disruption in the Indian context over the course of the next few years. So you get to see that the US economy reacted in a knee-jerk fashion in terms of the cuts in rates, continued there for some time, but then had to hike very rapidly. On the other hand, someone like India, the rate cut was a lot more nuanced, and that's why the rate hike was also not a lot more nuanced. So that gives you, we had seen earlier, if you recall, there is a very high degree of policy uncertainty at the global scale. I think in case of India, in a lot of cases comparatively, we have actually witnessed a lot better policy continuity, a lot less policy uncertainty, which is a very strong factor. Very clearly, if you see, this is another on the financial market side, a very important parameter or indicator is the government bond yield. And you get to see that in case of the government bond yield, we have seen a lot of volatility in the US 10-year over the course of the in the overall in the course of the last few years, and a lot of two-way volatility. See, in an indicator like this, volatility is bound to be there. But in case of the Indian 10-year bond, also you get to see the market has been relatively more range bound. And you need to keep this in mind that in case of the red line, the levels are like 3%, 3.5%, and still the absolute quantum of volatility is very, very high. In case of this blue line, the absolute magnitude is more like 7%, 7.5%, and still the overall volatility is relatively less. I think these are some of the very clear indicators which suggest that how exactly we see how exactly we see a little relatively better and more stable scenario in case of the financial markets more often than not that we are witnessing or we are enjoying at this moment. If I see a couple of other indicators, if I see that S&P, that is the global price earning ratio, the price earning ratio seem to have gone very, very high. That means price earning ratio is what? That compared to the overall markets or the listed universe overall earnings, what is the price? That means if the number is 50, that means this particular index is the payback period is kind of loosely speaking, the payback period is 50. If you invest at today's price and all the earning forecasts are met, that means in the next 50 years you will actually get your money back. Whereas in case of in the Indian context, the number is a lot more sober. You actually see that this you actually, and this is with the even without the prospect of a relatively higher growth kicking in and the earnings moving higher at a different level. So overall, you see the financial markets are also staying at supportive levels and possibly offering a better scenario or a more stable scenario in more often than not. I could speak a little more about how exactly the dollar index is moving, how exactly the something like the hedge against uncertainty, like the gold prices, etc., are moving. But given that we had talked about already for close to 45 minutes, I think I'll stop here. But I look forward to some of the questions from your side and happy to get into a more like Q&A mode rather than going for a monologue at this moment, especially given that this is an online conversation and I don't I don't have the chance to interact with you so very easily. So I stop here, but happy to take questions and feel free to ask whatever you want.
Thank you, sir, for such a brilliant session. Now we'll be having our question and answer segment. So, sir, the opening question for the day is: how do the global megatrends influence investment opportunities in the financial market?
Right. I would like not to go back to any slides, etc., but just try to explain you. So one particular factor is we get to see, as we discussed, that growth is not given across the globe. Growth is not given, so there is a very clear search for growth, right? On the other hand, we have seen the cost of capital, that is the interest rate, which we get to see, cost of capital is relatively low. So there is some bit of capital or a sizable quantum of capital which is in search of growth. And that's why if there is an economy which can actually show stability and growth, that will attract a lot of capital. No wonder you get to see that interest rates or bond yields, etc., remain very well anchored in a country like India. No wonder today you get to see that when you hear a little bit of uncertainty about the Chinese economy, a lot of uncertainty about the FII flows. I think the need of the hour is growth with stability, especially given there is so much of policy uncertainty and there is still so much of capital at a relatively low cost. So the key thing is deliver growth with a lot of certainty, which we get to see. Thankfully, we seem to be doing it, and no wonder we are attracting a lot of interest, lot of capital straight away for that. One particular enabling factor, a very important factor, is to build the ecosystem around it, or some of the things you get to see, the global bond yield inclusion, Euroclear mechanism, all these things in media you might have heard in bits and pieces. I think those will be important constituents or supporters for growth to continue or FII interest going ahead at a continuous basis. But looks like there is very clear positive disposition on the part of policymakers also about these things. They are taking these things into account very clearly.
Thank you for the answer, sir. Moving on to the next question, we have: how does the digital transformation impact economic structures and productivity?
Right. I think that's a very important question. I didn't speak too much about that during my initial comments, but let me put it this way: that if you actually see uh, a lot of digital penetration, that has two very important, two very big, but potentially diverging impact. Let me try to explain what I mean. On one hand, it opens up a lot of opportunity for a lot of people. Like, say, someone sitting in a remote corner of a country can actually enroll for a very high profile or top end course at a good university anywhere in the country, or even why anywhere in the country. Yeah, maybe at anywhere in this universe, and at a relatively more affordable price. So there is a bit of democratization of power, which was not earlier available with a lot of people in terms of education, in terms of healthcare, in terms of businesses. So an artisan, a very high quality artisan sitting at a remote village today, if he or she can actually capitalize on the digital network well, her market is not necessarily the next village, next market, next town, next city, next district. Her market can actually be the global market potentially, right? So these are very, very important empowering and democratizing element that is coming in the way of to a lot of people. That clearly gives a direction where efficiency becomes a lot more important, quality becomes a lot more important. Having said that, there is one word of caution that if digital high-end competition becomes a norm or becomes the usual game, uh, then there is one segment of people who can't even afford that. The game becomes very, very challenging for them. For example, if I the COVID days memory is fresh in the minds of a lot of us still, or if not for all of us. In case of at that point of time, think about the outcomes in case of the school education, for example. The schools, the more well-known schools, the schools with better infrastructure, the students who have better infrastructure didn't really lose much apart from the in-person teaching part, but at least something they could get very clearly for 2 years. But someone who doesn't have the access even to that, kind of for them, that is a those 2 years were lost. So basically, I'm saying it's a very strong tool with a lot of democratic elements in that and a lot of empowering elements in that. And a country like India possibly will take a lot more advantage of that compared to many other countries. But at the same time, at a policymakers level or at a macro level, we need to take care of those who can't even afford that. I think that is an additional responsibility for all of us.
So the answer was surely an informative one. Thank you so much. Moving on to the next question. What are the key challenges and opportunities for the banking industry in the coming years?
Uh, Well, this is banking industry or the finance industry at large. Uh, Come what may, it's very difficult to imagine a situation where it won't really be playing a very significant role. So basically, what we get to see, we are entering into a phase where you get to see a lot higher emphasis on efficiency again in terms of using your finances. At the same time, making a lot more investment in research and development and a lot more development in automations, etc., etc. So all those initiatives would require huge amount of fund involvement also. And we get to see banking and finance industry, BFSI industry in general, will continue to play a very key supporting role. Now, one particular interesting aspect here, possibly what you get to see that with additional efficiency gain across the process, the share of working capital finance vis-a-vis the long-term developmental finance such as research and development, etc., the ratio will possibly be changing. You might actually be financing the long-term needs and the long-term enhancement and up moves a lot more rather than the day-to-day financing. That way, not only the banking and financial system continue to play a very key role, possibly they are actually part of a slightly stronger contribution rather than just managing, or rather, they would possibly be offering a more high quality finance rather than just helping businesses to manage their day-to-day capital, because businesses will take care of those aspects a lot better with the advent of technology at all places.
Thank you so much, sir, for that insightful answer. Following this, we have another question. Are there specific sectors or industries that will play a crucial role in driving economic growth in the near future?
That's a tough one. I tell you, it's easy for me to say that banking will do that, digital IT will do that, maybe pharmaceutical will do that. But to be very honest, I think there is opportunity for a lot of sectors to contribute, reinvent in their own ways, and contribute constantly. Uh, I don't see any lack of opportunity in case of the education system. I don't see any lack of opportunity for the hospitality segment. I don't see any lack of opportunity for travel. I don't see any lack of opportunity for healthcare. So opportunities are there across industries, but possibly earlier with relatively or rather information flow becoming so much more better and scalability potential of industries and companies becoming so much better. You have to really be at the top in that particular industry to really get cater to more and more people. So there's a famous proverb that winner takes it all. I'm not saying winner takes it all, but it will possibly be within the industry. It will be eventually be a few players contributing a lot more. It can actually be the phenomena, not necessarily always in terms of number, but at least in terms of quality.
Thank you for the exciting answer, sir. Moving on to our fifth question. What indicators do you prioritize while assessing economic health?
Sorry, could you repeat that one, please?
Yeah, sure, sir. What indicators do you prioritize while assessing economic health?
Good question. I think we always look at there are two segments, 2 to 2.5 segments. I'll tell you what exactly you need to do. Obviously you need to see growth, because eventually, ultimately, at the end of the day, everyone is trying to do for higher growth for the economy, higher growth for business, higher growth for per capita income. For everything, you are actually trying to go for just pure economic parameters. You need to go for uh, better numbers, better growth, more positive outcome. But in order to get there, you need a very strong foundation of a few factors. For example, uh, the threats need to be kept in check. In the sense, you need to have an inflation scenario which is stable and somewhat predictable. You need to have a deficit scenario on the external front, that is the current account deficit or balance of payment situation, which should be in such a shape, in a healthy shape, so that there is no pressure on your currency. Your fiscal situation or fiscal deficit or the government deficit and public debt should be healthy, so that you don't get into a situation of interest rates starting to move higher. So basically, there is a few. You remember that two factor that motivation theory, that certain indicators are hygiene factors and something is a motivator. These are some of the hygiene factors you need to maintain, but ultimately you actually try to go for that motivator, which is growth, per capita income, etc. So these are the two blocks. But increasingly, as I said, that there is a third block which is possibly becoming very very important these days with every passing day. That is trying to ensure distributing the benefit of that growth across the society, or taking care of the equality part or the potential inequality in the system, because that remains some kind of a nagging issue in all countries, including ours, and all other countries. So how exactly you tackle that, that's possibly another socio-economic factor that all of us would have to bear in mind going ahead.
Thank you for the answer, sir. Our last question for the day is: in wake of the COVID-19 pandemic, what long-term changes do you foresee in the consumer behavior, and how can businesses adapt to these changes?
Very very interesting question. uh, I think it depends a lot on as they say, right, that it's not only the person, it's also the environment what actually determines or pushes people's behavior or influences people's behavior. I think that is also very important from a macro point of view. I'll take two countries at this moment. One is, say, India, one is US. In case of US, when COVID came, there was a, as we discussed, there was a lot of push. I mean, easy money given by the government in terms of fiscal spending, coupons, etc., as well as interest rates were brought down dramatically. The central bank infused large quantum of liquidity. That means that is giving the citizens, or a large segment of citizens, or encouraging a large segment of citizens going for a higher degree of consumption and higher degree of consumerism, which can actually promote growth, or recover growth very quickly in any economy, and which we have seen in case of the US economy. On the other hand, there are certain countries, India is an example of that, where it was not really so easy, or not really that much feasible for the government to think, to forget about the fiscal health, just spend money like that, or for a developing country or an emerging market to just cut interest rates like crazy. So we, in terms of the policy support, were a lot more nuanced, a lot more balanced. There you get to see that people rediscovered the value of saving. People rediscovered the value of, so possibly in one place you see someone buying a new I mean automobile, and in another country people rediscovered the value of going for a new insurance policy also. I think at the levels of life cycle of the economy, levels of development of the economy, both are appropriate. And we get to see and this actually reinforces the belief about the ability of people at large to take the right decision for their society and their level of development, that they possibly take exactly the right decision. That's why we get to see that possibly in case of some of the other countries where the medical infrastructure is not that strong, people possibly will be investing a lot more, the public money I'm talking about, on healthcare, on digital infrastructure, etc. In case of someone who is, or a country which is much more developed at a much advanced stage, possibly you got to see that their priority was to just boost growth quickly, and just to go for a higher degree of consumerism. So I didn't really deliberately didn't get into the sectors that I mean, after COVID, which sectors might gain. But I think this is a much bigger overarching phenomena which we have witnessed, and very, very important for you to spot all this, for you people who are related to some kind of business, commerce, economics, kind of a stream. It's very, very important for all of you to witness and watch that.
Thank you, sir, for knowledgeable, apprised, and sharp answers. With this, we come to an end of our question and answer segment. Before moving forward, I would like to inform all the attendees that the credit form has been pinned to the YouTube chat box, and it shall remain open for the next 5 minutes. And all of you are requested to fill in the same to avail 2 hours of non-academic credit. With this, I pass on the proceedings to Varun.
Thank you. As we conduct this remarkable speaker session, we have strong confidence that the insights shared today will prove valuable to all our participants. Mr. Siddhartha Sanyal has undeniably illustrated the fundamental aspect of life as well as business, serving as a source of inspiration and motivating us to work harder and smarter. On behalf of the Entrepreneurship Development Cell of St. Xavier's College Autonomous, Kolkata, I extend a heartfelt gratitude to Mr. Siddhartha Sanyal for sharing his expansive knowledge and experience. It is an absolute honor and privilege to have had the opportunity to host such a respected personality. So his willingness to take his time out of his busy schedule to engage with our audience is a reflection of his commitment to mentoring young minds for the corporate world ahead. A special mention to our respected father, Reverend Dr. Father Dominic Salvio, SJ, and Vice Principal, Reverend Dr. Father Joseph Kulandai, SJ, and Reverend Dr. Father Peter Arokyam, SJ, and Professor Bertram Das Salvia for encouraging us to pursue greatness and live up to the great Xaverian reputation. I also thank our faculty advisor, Dr. Arup Kumar Mitra, for his leading supervision and support to every step. We extend our sincere thanks to our attendees for their patience, active participation, and for posing such compelling questions. Last but not the least, I would extend a deep sense of appreciation for all the support, timely implementation, and guidance provided by the members of the Entrepreneurship Development Cell. We owe the success of the session to you. Once again, thank you for all for turning in with EDC. Have a great day.
Thank you very much for organizing this. It was really a pleasure to interact with you, and it's especially heartening to see that it's not only a purely academic discussion. The focus on enterprise development is possibly the need of the hour, and thank you very much to you all to put that into practice. Thank you very much.
Thank you, sir.